Claire Smith from Schroders. Welcome to the Alternative Symposium.
Thanks for having me.
A couple of questions for you today. The first one is, can you explain the unique approach used by the Schroders Private Equity Fund?
Yeah, sure, I'd love to. So we've got a team that's been operating in the private equity markets for 25 years, doing deals for institutional clients, traditional fund structures. And what we've done with this fund is we've created a retail access point for individual investors in Australia to access the deals that the team are doing around the world, and with an element of liquidity. So, more liquid than the traditional closed-end funds that people are familiar with, but obviously less liquid than, listed equity funds.
And why is that sort of diversified approach better suited to retail investors?
Yeah, well, the way we structured the fund and the way we think about it is, if you're a retail investor, you might only have enough capital to sort of access one private equity strategy. So we thought by adding, Europe, the US, Asia, access across primary, secondaries and co-investments. So the portfolio is now about 120 companies in total. The idea is to get that to about 250 to 300 companies. And we think that provides adequate diversification for investors, because statistically 1 in 10 buyouts will probably perform badly. So we want to give people enough of a diversified exposure that if this is their only private equity exposure, they can feel comfortable with the diversification they're getting from that single access point.
And so does this help with the kind of vintage problem and the ability to keep allocating to the asset class?
Yeah, absolutely. And I mean, when we structured the fund, so it's evergreen, so you make a commitment, any exits would be first made available for redemptions. If there's no redemptions, it'll be reinvested. So you get this continually maturing and growing portfolio of companies. We've actually found it's been popular with institutional investors as well, because, sometimes you commit to a private equity fund, it does well, but, you make an exit and you've suddenly got money back that you have to reinvest. So we're finding even institutions around the world quite like the fund structure, because it takes that continual need to reinvest stress off them, and they just have a portfolio, as you say, with diversified vintages, diversified geographies, and we just continue to find the best opportunities for them around the market.
And what are the underlying investment types you've got within the strategy?
Yeah, so we invest through third-party fund managers along in their primary programs. We also do a select variety of secondary positions, but where we really add value is we do a lot of co-investments. So the fund is over 60% exposed to co-investments, and we do side alongside those primary partners that we have. So we specifically focus in the small to mid-cap segment, and what you find in this segment is funds may only be $200-300 million of size. Companies are generally trading that the company size we're looking for is sort of that 50 to 100 million range. So there's lots of co-investment opportunity available. So what we love to do is find a good manager who's specialised, raising a small fund. We commit early and large to their fund, and then they're very loyal when it comes to co-investment. So we get a lot of co-investment flow. We can select the ones that we think are going to perform well, and then we entrust the manager we're invested alongside to grow that company, have a seat on the board, a seat on the management committee, and decide, how that growth trajectory will eventuate, and then the opportune time to exit.
Can you, I'll start that one again. Can you provide an example of one of the successful companies or exits? I know a lot of it's private, but...
Yeah, sure. But on a no, well, there's one that we've now fully exited, which is IPO'd. It was a company called PopMart. Believe it or not, they make tiny little fashion dolls in China. It's a guy straight out of university who set up the company. He's now a billionaire. We invested in September 2020 in a co-investment. It IPO'd in December 2020, and our valuation went up 5 times in that space. It did give off, we had to hold it for 6 months post-IPO, and the China market came off a little bit, but we still managed to fully exit that and make 3.6 times our money in around a year. So yeah, we're pretty pleased with that. And there's another exit we're working on at the moment in a German consulting firm. It was a bit of a tumultuous ride, because when COVID hit, we actually valued the company down, because we thought, well, what's the first thing if it's a recession people stop spending money on? It's consulting fees. But they picked up a lot of contracts with the German government to help them transition to working from home. They're helping the German government automate a lot of things like activation of passports. They've got contracts with all the German states to sit behind the passport activation. So that's been a huge success story. It's more than doubled our base business case, and we're looking to exit, but we're actually hoping that the the fund manager and we invested alongside is going to sell to a bigger private equity fund. And what we're negotiating is if we can actually keep half of our exposure. So we'd sell half of it. Looks like we might make around 2.5 times our money back, and we get to continue to hold 50% of the company because we've only held it for 2 years and we think there's a lot more growth to be captured. So I think that's one of the benefits of our sort of the way we invest, the way we work with fund managers, and our partnership approach is a company like this where we think there's still room to grow. You know, we can exit, make more than our money back, and continue to have exposure to a company that we think is going to continue to perform in the future.
And can you explain the role of secondaries within the portfolio?
Yeah. So when we first structured the fund, we thought that secondaries would play a pretty important role because they tend to have a shorter lifespan than primaries or co-investments, and that helps to create that liquidity if we did have redemptions within the fund. What we found over the past few years is the traditional secondary market we feel is quite overpriced. It's been a lot of dry powder's been raised in that market. There's a lot of competition for assets. So where we've really put our efforts into the secondary market is what's called GP-led secondaries. So where a manager rolls an asset into a fund that's approaching its legal maturity into a new fund, a rollover or a continuation fund it's also called. We really like these assets because you know who the manager is, you know what the company is, you can see how that manager has operated that company for the past 3 to 5 years. You can look at their original business plan and say, what did you aim to achieve with the company? What have you achieved? You know, what's the plan for continuation going forward? There's no change in management, so there's no disruption to the operation of the company. So it's a nice smooth trajectory. And because we're a very big investor, you know, we invest $2 billion US per annum in the market, we can hard underwrite those opportunities as well. So we're quite proactive. We'll go to a manager where we like the manager, we like the company, and say, we can see your funds maturing, we'll hard underwrite it. So anyone who exits will replace. So that's great for them because they don't have to pay placement agent fees to coordinate that role and make sure there's enough coming in to exit. We've taken all the stress of that rollover out of the picture for them. So yeah, the GP-led secondaries part of the market is one we're really passionate about and have been really focusing our efforts in lately.
Claire Smith, thank you.
Thank you.